April 18th, 2024. If you watched my video yesterday, I mentioned that I thought we were going to get a reversal from the 63 close if we ended up getting there. And the reason was bar 63 was a reasonable buy. It wasn't a good buy, but it was in theory a reasonable buy, the close bar, because it was a really big bar. So when I say it was a reasonable buy, I mean it was, there are theoretically some algorithms that are buying that close. And what they're doing is they have an extremely wide stop and they're scaling in, knowing that if they scale in, for long enough that we're going to get back to the 63 close and there should be sellers there. And, nothing is random in the stock market down to the size of bars 1 and 2. Why are the size of bars 1 and 2 not random? Well, as I often say, when you get some sort of spike on, or I guess it's Al's method, but I say it a lot. When you get some sort of spike on the open, it usually ends up being some kind of measured move, whether it's the upside or the downside. You can see today the size of bars 1 and 2 was basically right to the close of bar 63, and that's not an accident. When a measured move creates, heads right into some sort of other support or resistance, that happens all the time. It's not an accident. It's the algorithms, creating traders equations by doing that. So if you know what you're looking for, pretty reasonable to take a trade and go for that 63 close, I think. And you can see that's exactly where traders sold. Bar 1, a big bear bar closing near its low. Good for the bears, but you're in the middle of yesterday's tight trading range, so not as good as it could be. You get follow through for the bears on bar 2. It's theoretically sell to close, and maybe going a little bit lower, but I don't really want to sell. I think we're too low in a trading range from yesterday, so I would rather wait. Bar 3, a bull bar with a tail on the top. I personally don't trade the first 6 bars of the day because I just prefer to wait and wait for more information. So I don't really trade, but bar 3 is definitely a credible buy. It was probably the best trade of the day. I would say I don't know, 30% chance that it's the low of the day. Maybe, once we start to get follow through like 4, maybe it goes up to 40% chance it's the low of the day, but definitely an okay buy. But if you're buying above 3, you have to realize that it's low probability and that 1 and 2 are pretty strong and they're probably going to get a second leg. So if you're buying above 3, you can't really exit during 5 or 7. If you're buying there, you're buying holding for a swing. So it doesn't really make sense to buy above 3 and get out anywhere in here. You got to buy and pretty much just hold. And then, once you start to get up here, then you can start pulling your stop. But me personally, if I bought here, I'm sitting through this. And then once we get bar 8, then you can probably put your stop below 7. And then, once you get, 13, you can put your stop below 11. But, I don't think it makes a lot of sense to buy above a bar like bar 3 and just get out quickly. I think you have to sit through a sideways pullback because that 1 and 2 are really strong and you're going to get a second leg and potentially form some sort of lower high. The market's going to try and trap you out on the open. And that's essentially what I tried to do with bars 5 and 7. Bar 4, a big follow through bar, but right at the moving average, so not as good as it could be. Bar 5, it's a low one short, but I'd rather not take it. I think we're just going to continue sideways here. The bears see a lower high and a low one, and they want the measure, to sell and get a break up to the downside. But I don't think that it's all that likely. I'd rather wait for follow through. 6, a bull bar, an inside bar closing, around its midpoint, or sorry, above its midpoint. I would still rather wait. We might get a second leg down from 1 and 2. And you can see that's probably what 7 was, that second leg. Some traders, maybe they don't buy directly above 3 in case it's a trap, but once they see 4, they now know that we have consecutive bull bars. So what they'll do is they'll set a limit order to buy the 3 high during bar 5 or something, and that could be one of the causes of 6. And as 7 trades back down, traders know it might be a second leg trap, so they're buying the close, trying not to let it essentially trade down below bar 4 or below bar 3. They know that 3 and 4 are also strong enough for probably another leg up, and we might end up getting a bit more to the upside. So traders are buying that close, hoping that we're going to start the rally. And then we do on bar 8, big bull bar closing near its high. You can definitely buy above 8. The problem is 3, 4, 6, 8, possible 3 pushes up. And 1 and 2 were strong enough to make traders think that it might be a trading range. So sometimes bar 8 is a trap. So it's a little bit tricky to buy directly above bar 8. But what a lot of traders will do is they'll wait for follow through. And where do you get the follow through? Bar 9. Now, is bar 9 really ideal follow through? No, it's not. But if you wanted to buy above 8 and you were just barely hesitating a little bit, you said, okay, I'll wait for follow through. Bar 9 gives you essentially, similar risk or basically the same risk reward and a slightly higher probability. So I think, okay, definitely okay to buy above 9. You get follow through 10, but it's a failed breakout of the high of the day. Probably buyers below, probably sellers not too far above. And you can see traders bought below during bar 11. Probably a second leg up from 8, 9, and 10. 12, a big tail on the top. Probably, you can see we got sellers, failed breakout of the high of the day. and then 13 a bull bar closing near its high. I think, most traders are probably pretty convinced we're going to get to the magnet 63 at this point. It's just a question of how are we going to get there? Do we go straight there? Do we go a little more sideways first? So what is the path of the market going to be? So I thought, okay, to be long and holding, hoping to get to that 63 close. 14, a big tail on the top, kind of surprising. I thought that more likely after 14, if we started to trade below it, we would start to go a bit more sideways and we might get some sort of pullback and then traders would look to buy. But instead, traders buy the close of 14 and don't let it trade below, and we get a bull bar closing near its high 15. Can you buy above 15? It's an inside bar. It's a high one. It's a potential one bar final flag, but I think definitely okay to be long above 15, going for that 63 close. Follow through 16, inside bar 17. Traders will exit below 17. So what a lot of bulls do, and this is interesting, if you bought the close of 17, you get pretty easily 2-1, I don't know, and then another 2. So you get pretty much 4-1 buying the close of 17, trying to get to the 63 close. And all you're betting on basically is that we're not going to drop down immediately. And you only have to be right here, 25, 30% of the time for it to be profitable. And you're probably going to be right like 40% of the time. So I think really pretty reasonable to buy the close of 17. And that's why we got a micro gap up on 18. So buyers on the close of 17, and we got the rally on 18 that traders were looking for. They got a pretty quick 2-1, and a lot of traders just took profits, and that's what caused the big tail on 18. A lot of times when you have an obvious magnet like the 63 close, it doesn't quite get there, at least on the first try. 19, a bear bar closing near its low. Bulls will exit again, but again, bulls know that other bulls will exit. So what do? They buy the close of bar 19, put a stop below 19, risking a couple of ticks, trying to make 8-9 points, and you don't have to be right very often for that to be a profitable thing to do. So you can see 20 big tail on the top, but it was okay for some buy the close bulls. Followed through 21, and then 22 reaches the magnet and sells off. 23 was interesting. 23 traded above 22 within the first 2 minutes of the bar, and odds are there was going to be sellers up here because of the 63 close. So I thought it was okay. I didn't do it, and this is purely experimental thinking. But I made a note as 23 was trading above 22 that I thought you could sell above 22. And if you ended up getting, a bull bar closing near its high 23, you just get out since it's always in long. And if you don't get a bull bar closing near its high, maybe you try to make 5 points, whatever, and see what you get. And you end up getting a big bear bar closing near its low 24. Pretty good for the bears. So 24, failed breakout of the 18 bar range, double top with 64 yesterday. At the top of that buy climax, pretty reasonable sell. You can see the neckline of the double top is bar 2, so traders going to try and get a breakout below that neckline. You can see we broke out below it, but ended up oscillating around it for the remainder of the day. Okay, sell below 24, but the problem is that the channel up is really tight. So when the channel up is this tight, you have to realize that we might end up going sideways for a little while first. So your follow through is not all that ideal. 25, 26, 27, 28. Tails 25, 26, 27, and 28. When you get a bar like 28 after 3 dojis, you're probably selling the bottom of a trading range. You're selling below 28. So probably better to look to sell where the trading range started. That 24 through 28 is strong enough for a second leg down, and it's probably strong enough for a lower high. So the question becomes, where are we going to go? And oftentimes what gets tested when you get a spike in a channel, the top of the channel gets tested. And the channel is the 25 high. So you can see that's essentially what we tried to test on 31 is the 25 high since that was the start of this channel down. But 26, 27, 28, a couple doji bars, 29, a bear bar, but not really all that great, closing at the moving average. 28. So 29, buyers below 28, you can see, and probably sellers above 30. 31, a lower high, a double top, but I'm having a lot of trouble selling this. You definitely could take the sell 31 for a swing, but basically 3 consecutive doji bars and, 20, you could argue 25, 26, 27, all doji bars. So you basically have 6 dojis and 7 bars. So I think pretty tough to sell 31. I'd rather wait for follow through. You do get some follow through 32, 33. Probably sell the close 33, but inside bar, potential final flag. But I think okay swing sell. Pull back 34. Some traders might exit above 34. Hard to get back in, I thought. 35, a low one short, but not all that great. And 36, outside up. 37, big bear surprise. Kind of changed the character of the day. Bulls wanted a reversal up, but they wanted a reversal up from down here. So if you got bar 36 and then you immediately got, I don't know, what's a good bull reversal bar? Something like This with a bigger body, just an ideal bull reversal bar. I'm going to make a bad drawing, but I don't know, something like this is dumb. I'm trying to demonstrate the ideal bull reversal bar. I think it's where the body is about, yeah, something like maybe 48 or maybe a smaller version of 48. They got on 38 as some sort of reversal attempt up. That's what the Bulls wanted there, because once you're up here, the risk reward is not all that good, and you're back in the middle of this tight trading range. So, I think it's harder to buy above a bar like 38, even if it closed on its high, because the risk is so big and you're buying so high in a trading range. The point I was trying to illustrate with that horrendous drawing was if you get some sort of reversal bar up that closes, maybe here and traps traders in below here, you're at the bottom of this buy climax as well. So reasonable, probably 3 or 4 to 1 risk reward, just taking a chance we get a second leg up from this. But again, tight channel down, so that's part of the problem. But when you have that kind of tight channel, you want to buy as low as possible. So that was essentially the point there. 39, you could argue it's an II. 38 did trade above 37, but still a reasonable II. Follow through 40, 41 for the Bears. It's sell to close, but it's kind of hard to do this deep in this bear trend. 42, a doji bar. 43, a doji bar. So, I think probably coming to an end pretty soon. And you get 44. So what happens on 44? What will bears do above 44? They'll exit. And if bears will exit above 44, you have bearish algorithms that are the same as the bull algorithms that are buying the closes of bars like 19, trying not to let it trigger. Those same algorithms are selling the closes of bar like 44, trying not to let it trigger. And that's why you get the follow through 45, big tail on the top, follow through 46, big tail on the top, and on the bottom, sorry. And then a big bear bar closing near its low 47. These are all sell to close bars. I thought it was possible we started to get a vacuum down to 5,000. But this obviously becoming increasingly parabolic as it moves, you can see. And, again, the thing, the drawings I always do with, imagine 45 down and then up on 45 down and then up on 46 and then down on 47, potentially a parabolic wedge. The same way 39, 40, 41, probably a parabolic wedge. And you can see we got a pullback 42, 43. I still don't think there's anything wrong with selling 47. To break out below, the neckline, break out below yesterday's low. I think it's okay, but it's essentially more of a swing sell. So I'd rather wait. 48, a big reversal up, surprise. Instead of sellers below 47, we found a bunch of traders exiting, and then 49, a low one short. But after the big bull bar, 48, we might get a second leg up. Probably still okay to be short, just stop above 48 where traders would exit. 50 follow through, and then 51 trades down to the 49 close, but traders who sold the close 49 scaled in above 49. Sold the close 47, scaled in above 47. Disappointed with how strong 48 closed, obviously. So they used 51 to try and get out around break even on that first trade. And that's what caused the buying on 51. And, one of the ways you can obviously try to predict that is, when you think about how disappointing 48 is for any bears who are short, it, drastically reduces the chances of this becoming a big bear trend. So it increases the chances that those traders are going to be disappointed and buy back short. And that's exactly what happened on 47. And, in theory, there are bulls buying with a limit order here too, since 48 is a buy climax and we're at the bottom of the buy climax. So there are, in theory, traders buying with a limit order here. And if 51 closes on its low, below the 48 low, they'll just get out and take a small loss. Double bottom 51, but probably a trading range starting at 48. So if the 48 high is the trading range, if you're buying above 51, you're buying high in the trading range. I'd rather not. And a big tail on the top and the bottom, I'd rather wait. Disappointing follow through 52. So if you did buy above 51, you got to get out on 52. That's probably part of what's causing 53. 53 second leg down. We're forming some sort of triangle here. You can see we're essentially forming a triangle, and we're trying to get a breakout of the whole thing. This whole thing ended up being more or less an expanding triangle. Well, it's funny. You can actually look at this as an expanding triangle or just a normal triangle. You can see we got essentially a normal triangle here, but expanding triangle, 48 high, 57 low, and then 59, 61. So really, when you can look at something as an expanding triangle or just a normal triangle, that's your flag that you're in a trading range. And better not to do anything. I don't think there's any good trades from, I don't think 51 was a good trade, but I thought it started to become clear that it was a trading range basically when 51 happened. And I don't think there was any good stop order trades for the remainder of the day. So 50, 54, I think, but potentially a three push pullback. So you got the bear spike down to 47, then 48, 52, 51, 52, and 54, three push pullback, and potentially bears trying to get follow through 55, 56. 55, the bear bar, but not quite closing near its low. If you can get follow through 56, 57, maybe we are starting to move down, and that was just a pullback, but instead failed breakout below the low of the day. But 57 not able to close on its high and become a failed breakout below the triangle. And the triangle could be some sort of final flag at the bottom of the trading range. So I thought if 57 closed on its high and was a bit smaller, a bit more reasonable. And instead, it doesn't. And you get big follow through 58, but tail on the top, 59. But again, a big tail on the top, just basically testing the 48 close. Reversal down 60, 61, but 61 does not close below 57, which is disappointing. Bears, they want follow through, maybe one more bar, 60, had 61 close below 57, I think probably an okay sell. But you can see it never even triggered. Disappointment 62, had 62 closed on its high, probably an okay buy for a failed breakout. But you can see just every possible stop order trader, 57, not as good as it could be. 55, not as good as it could be. 61, not as good as it could be. 62, not as good as it could be. So this is your sign that you're in a trading range. Follow through 63, but a tail. And you need one more bar at least. And 64 is not that one more bar. That one more bar needed to look similar to 63. So not really as good as it could be. And traders exiting disappointed, 65, 66, second leg up. And basically at this point in the day, when you see this much trading range price action, you should be extremely resistant to trading. And, earlier in the day, it's okay to take chances, I think, in third legs like bar 8. Because bar 8, it is a third leg up, but it's a really big bar and it's more of a surprise and a clear always in long flip. We weren't clearly always in long until bar 8. And bar 8 made the market clearly always in long. It was a third leg at the top of the trading range, but it was strong and it was early in the day, so more okay. But less okay to take chances late in the day because it's just more likely that you're going to get something disappointing. Stop order trades today, 3, 8, 9, 13, 15. I don't know, probably 24, but hard to do. Maybe 33. Probably sell the close 39, 40, 41. Maybe 45, 46, 47. And then I would, I don't know. I'd probably, maybe 49, but I'd probably just be done on the day. This is disappointing. And then, you're just going to sit through the rest of this. The daily chart, the bulls yet to get a bull close. So pretty tight bear channel down. We're going to 5,000. Maybe we get a vacuum test of 5,000 tomorrow. It's Friday, who knows? But we're definitely going to 5,000. I didn't think, like I said, when we were up here, I did not think this was going to happen. I thought this was a low probability day, and it ended up getting follow through. On the weekly chart tomorrow, obviously, like I said, it's going to be a big bear bar. The question is it going to close on its low? But yeah, that's the day.